Okay, well, again, thanks for having me here today, and I hope everybody's recuperating from all their big meals yesterday, so it gives you a little time to sit back, learn some stuff today, hopefully that you can start using this afternoon or Monday. So what I'm going to talk about here today is selling options for income, profits, and hedging, or opportunistic hedging, because once you kind of understand the option strategies and stuff that I'm going to talk about, it really does present a lot of different opportunities and opportunistic type hedging setups that you can do. So let me get rolling here. So it's a 6-step plan for option trading success. Step 1, we're going to look at the secret trading profits using options. 2, how to maximize your option profits. 3, selecting the right directional option strategy. 4, how to trade time. 5, directional option trade review, and then how do you bring this all together. So the following webinar here today is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So let's take a look at the secret trading profits using options. Now, option trading has so many more advantages than trading stocks, but as you may already know, it's a bit more complicated as well. Now, but once you understand the benefits and advantages of option spreads, you're really going to never look back. So the key to swing trading, that's trades that last more than a day, is for me is to use option spreads, and there are a lot of different great advantages to using options and option spread strategies. Now, one thing, the unique pricing structure and capabilities that option spreads offer you really help you to control the probabilities and the risk of your trades. And you can actually then, start to tilt those probabilities more in your favor with certain option strategies for certain market conditions. So when used correctly, option spreads are going to keep your capital at risk low. You can really define your maximum risk, and options provide you fantastic leverage for your trades. So how do you maximize in your option trading profits? Well, it's, knowing how option pricing works, and that's the first thing we want to look at is, what are the key components that go into option pricing, and how do those affect the price of an option? And the biggest component for pricing options in general, period, is time. So when trading options, the most important factor really comes down to understanding the concept of time and the impact that it has on the price of your option. And time value is what we also refer to as the extrinsic value of the option. It's the premium a rational investor is willing to pay over its current exercise value, the intrinsic value, based on its potential to increase in value before it expires. Now, this probability is always going to be greater than 0, thus an option will always be worth more than its current exercise value. And the change in this value of the option is based on time decay, and we can actually, measure this using the Greek theta. And that's another great thing with options. You've got these various Greeks that you can use to kind of measure what price, what will affect price of the option and how to potentially adjust various conditions in the market using the Greeks. So the first one, though, is theta. Okay, so it's going to have a characteristics of what we call either positive characteristic to the effect of the option or a negative. And if you look at all long stock options, so if you're long a call or if you're long a put, those will have what we call negative theta value. And so that's going to indicate that if that price of your underlying stock or ETF or whatever you're trading, if it's just kind of grinding or moving sideways, really not making any headway in the direction of your trade, it's going to lose value as it gets closer to expiration. So it'll actually lose value each and every day, and that's what we call negative theta value. Now, all stocks options that are short, such as if you're short a call or short a put, those will have positive theta value. So that's going to indicate that your position, if it's kind of just going nowhere, moving sideways, you're actually gaining value each and every day. So that's the great thing with options. Once you understand the various characteristics, you can really tilt those odds and use those various option strategies and components of the options to take advantage of it for your various trading. Trade style or your trading option strategies that you're looking at. So let's take a look at the value of an option. So if we look at an option price, it really comes down to time value, that main component, then implied volatility, then the underlying value of your security you're trading. So if we look and then understand these variables, then you're going to be ready to price your option, and you're going to be ready to know what that option premium should be. So let's take a look at a price table here, and we'll go through an example to show you how these components really affect the price. So this is a table for a weekly option. So, you know, every Thursday we'll have a new option series that comes out. So yesterday was closed, but we'll have a new option series every Thursday on the weekly options. And, you know, most of the main options right now, you know, all the options pretty much have weeklies. A few are still monthly, but the ones that are mostly traded all have weeklies, which make it a great vehicle for our trading. So on the, you know, Thursday we have 100% time. That's that first day. So it's going to have a 100% time component in that option. So time value then times the implied volatility. And for this, you know, example, I, you know, will change the implied volatility around so you can see how these two components really affect the price. So time value times implied volatility times your underlying value of your security, and I kept that at 1, a constant, so we can see the premium, how it's just affected by these two components, equals the price of your option or the premium. So Thursday we come in, we have 100% time, and we have the implied volatility 300, and we kept this at 1, so we have a price of $300. Now you come in Monday and you can see that it's cut in half. Okay, so the time component, time value part of that option now is half of what it was that first day. So even if you increase the implied volatility here to, in this example, 800, you can see that it barely pushed the price up. So you can see that the price here is only went to 400. Now just think if you had the implied volatility and it was 200 right here, you can see that your price for your option would only be 100. So it's very important to understand how these affect options and the price of your option when you're buying or selling. And one thing you'll notice is when you look at time value, it goes to 0. And when you look at implied volatility, it's also going to go to 0. So these are two things that you can definitely take advantage of with different option strategies by understanding and then incorporating, you know, strategies that take advantage of time value and implied volatility. And that's one great thing when you're selling options or option strategies that are, you know, from the sell side, you can actually take big advantage of those two components. So the next thing we want to look at is then, you know, selecting the right option strategy. And one major goal, in my opinion, for every trader really should be to select trades or, you know, trading strategies based on what's going to provide you the most consistent positive return, looking for a kind of low risk, defined risk, and not always for that greatest return. So, you know, for me, I like to keep things more consistent and have a nicer, smoother equity curve rather than, you know, having a lot of volatility in your trading. You know, it's going to keep you in the game longer. It's going to make your trading less stressful, and it's going to make your trading, you know, more fun than a lot of worry and stress. So one way to achieve this then is by knowing the best low-risk option strategies that are available, how they work, and then selecting the one that's going to be best suited for the market environment you're trading. So when we look at various option strategies, you know, first off, I look at market direction first, and then I want to select the option strategy based on the conditions in the market. But some of the main strategies that I look at for kind of what I call these directional low-risk strategies are selling option credit spreads. The other one that I really like is what I've kind of termed the ninja credit spread, which is basically a ratio butterfly that we'll look at. And then being able to know and incorporate hedging of your positions when you need to hedge using, you know, these various types of selling option strategies. So then it becomes a strategy that you can use, which I refer to as opportunistic, because a lot of times you can turn a trade that's losing into a winning trade by knowing how to use the options to defend your trade. So when you're selling options or option credit spreads, some of the great advantages are that they can work regardless of what the market direction is. That's one great thing, is that you don't have to be perfect, you know, on the market direction or timing. So they can also work, and even if you're wrong, you can make the trade pay off for you when you're using the right option setup. And a lot of that is incorporating selling type of strategies. The other great thing about when you're incorporating selling options or option credit spreads is that you're going to see that the winning probabilities of profit when you sell at one standard deviation out of the money is going to be 80% or greater, and that's even without adding technical analysis, which then increases your profits probability even more. So, let's say you go into a trade and you sell something that's one standard deviation out. Statistically, that's telling you going into that trade, you've got like an 80% probability that you're going to have a winning trade. And then think if you had a trading system that's better than 50-50, let's say it's 60% of the time it's right, then that's going to be another 10 basis points that you can add to that probability of that trade being a winning trade. So that's the thing that you're going to discover once you understand the various strategies and how they work. So it really then comes down to trading time. When you think about it, if you're selling options and you're using that time component, you're basically trading time, and that's what we like about option credit spreads or selling options. Now you can sell options naked, by selling a naked call short, or you can sell a put short, but you're going to have a lot more risk involved with that. So that's why I like to look at using option credit spreads, which are basically you're selling an option, but then you're hedging it by being long an option against it. So let's look at the three major types. You've got three types of credit spreads. You've got the bear call credit spread, and that's going to be a bearish strategy. And then you've got the bull put credit spread. And then when you combine and match those two together, you have what we call the long iron condor. So the bear call credit spread is going to be one that you want to use if you think the market's going to go down. And it doesn't even have to go down. It can just go to sideways, or it can even go up a little bit depending on where you set your strikes. So that's the great thing. You don't have to be exactly perfect on direction. So basically what you're doing is you're selling one call with a lower strike while buying another call with a higher strike in the same month. So it's what we call a bear call credit spread. So here's an example. If you look at this trade setup, for example, you're seeing that this is on the index SPX, which is the S&P 500. So this was taken, this slide shot was taken way back when it was trading right here about 1988. But the strategy is all the same. It doesn't matter what market environment or price is. But what you're seeing here is that price was way down here, and look where the credit spread was set up. It was set up way above this market price where it's trading. So in this example, we were basically sold the 2045 call short, that red line, and then bought above it the 2050. So that's, if you look at that, that's a $5 wide spread. So $5 in one option contract is equivalent to 100 shares. So that's a $500 wide spread. So if you look at $500 and then you, in this example, received $100 credit, that's what goes straight into your bank account when you're selling a credit spread. So basically, you've received and brought in $100. So you're at risk then is the difference of $400. Now this is where a lot of people get confused, because you're going to say, well, why would I risk $400 to make $100? And this is what we call, that's a negative risk ratio. Now the thing is, when you're selling out of the money, look how far up this is. So this is approximately what we call, one standard deviation, and this is what gives you that potential going into the trade that there's an 80% probability based on, statistics on this, that it's going to close below that short strike. So there's an 80% chance basically that it'll close below that short strike, and you would then keep your $100. So, if you look at the probability, you've got a great high winning probability going in. Therefore, you're not going to make as much money as if you're taking more risk on a trade where you didn't have as good of a chance for it to be a winning trade. So that's the trade-off. You're willing to take less because you basically have less risk knowing this, the probabilities. So your risk then is the $400, and that's the margin that you'd put up. So, theoretically, to do this one option trade, you'd only have to come up with $400 in your account to enable you to do this trade. Now at expiration, if this closes below that short strike of 2045, you keep the $100, and that would be a 25% return on your capital at risk or that margin. So these are really great ways to incorporate this strategy with what you're currently doing, or this might be something you want to do just full time without using any other trading strategies. But I like to do the combination of adding, selling, credit spreads to buying and things like that, which I'll show you how you can do that. Now the other one is the bull put credit spread, and this is a credit spread where it's going to be used when you think the market's going to go up, and it's basically you're selling a put while then simultaneously buying another put with a lower strike and in the same month. So it's a hedge strategy. You don't have unlimited risk if you're wrong. And here's an example of a bull put credit spread. So if we look here, we'll see this is kind of going back and looking at this was when, and it was trading right here at $207. Okay, so you're really bullish, looking for this market to really move up strong. So you could have done a lot of different things. You could have bought the stock outright at 207. You could have bought calls, and you could have had an unlimited potential upside profit. But the other strategy was to sell an out-of-the-money bull put credit spread, which was selling way down here, again, about 1 standard deviation out of the money. So going into the trade, this would give you about an 80% chance that this would be a winning trade based on an 80% chance of closing above your short strike right here at 187. So it was selling the 187 put down here, and then below it, buying the 182. So again, another $5 wide spread, or $500. Okay, so on this example, brought in a $130 credit right there. So that goes straight to your bank account, and then your maximum risk is the difference. Now the other thing is here your maximum risk would be 370. Now if you did nothing to defend the trade, there are a lot of different ways though you can adjust these trades. And if win went straight down, you came in one day and it was straight down, you didn't have a chance to do anything, what your max risk is, 370. But what we'll do and what I teach is how to adjust these trades where you're not going to ever lose, hopefully, that full amount of capital that you have at risk. Now, as long as this closes above that short strike of the spread, then you keep the $130, and then your return here on your at risk or your margin is 35%. So these are really great trades when you get the right setup. You can see that you can make money even if it was to go sideways. You're going to make money. Even if it comes down some, you're going to make money. As long as it doesn't, close below that short strike, you have a great probability and chance of a winning trade. And going into it exactly what you have at risk, exactly your potential profit. And then what I like to teach all my clients and members is then, what do you do if the thing goes against you? So there's a whole lot of other variables involved, but that's just the basic, component of these types of spreads. So next thing I want to look at or show you is, what we're going to look at is a directional option trade review. So we're going to look at what I like to incorporate in a lot of these types of trades are what we call cycle reversals. And so it's when you're selling option spreads and things like that, and you don't have to be exactly right on time or exactly right on price direction, you can do these off kind of reversals where you see a market might be going up, and then all of a sudden it reverses and then it pauses and stalls. That's a really great position or cycle in the market where you can do these out of the money either bear call credit spreads or out of the money bull put credit spreads. So let's take a look at an indicator that we use. It's a cycle reversal indicator. It really helps to identify and give us alerts to a potential change in a market direction. So basically this is based on a relative strength indicator that we've put together and modeled, but what I like to look for using this indicator is situations where we have an extreme maybe oversold or an extreme overbought situation, and then we get a reversal, which we get a signal here. Here's what we call our signal trigger for this. And you can see down here we had a pretty oversold situation. This was on the Russell 2000, and this was just a few days back. It sold off real hard. So this was we'd had a bunch of reversal signals up here to the downside and had a really nice move down, and then you get a reversal off the lows from a relatively oversold situation and had a powerful move up. So what this then tends to lead to is that it's a great situation for selling a bull put credit spread out of the money below where the price was trading, or up here selling it out of the money bear call credit spread. So it's a really great tool for doing that type of trading. So here's your kind of directional alert, potential up on a cycle reversal. So in this situation, sell a bull put credit spread, something like that. So a great little tool indicator for that. Here's another example. This was a number of cycle reversals on Apple. So whatever you're looking at, it's a really great way to incorporate this for your trading strategy. So here's a nice overbought situation here for Apple. We had a reversal right here, get a signal, and boom, down it goes. But the great thing is if you're doing credit spreads, you don't have to have it just collapse on you. You know, as long as it just churns sideways here, if you're selling out of the money up here, you're going to make money on your credit spread from that time decay that, you know, basically you're selling time. Here's another one right up here. Now we got a reversal, but, you know, you could have sold up here and you're still, you did great down here, cover back your credit spread there. So a lot of great ways to take advantage of this kind of indication of a market change. And here's one more example here. This was QQQ. You can see all these different on the ETF, these reversals. So here's a nice cycle high right here. You can see how overbought it was. Here's another cycle high right here. Very overbought. Here's some cycle lows down here. So this gives you a great tool, and then you know, decide what kind of strategy you want to use. And when I get these first indication of a reversal, the first strategy I like to go to is that, you know, like a bear call credit spread or a bull put credit spread. So wanted to share that with you. Now here's what we call kind of a hedge strategy, and this is one of my favorite. I like this strategy a lot. It's basically what we call a long condor, a long call condor. So basically it's a combination of two different spreads put together, and let me show you how this works. So when you're looking at a long condor, basically what you've got is you're going to be trading a long call debit spread, or you can do this with puts, and then you're going to have a bear call credit spread on the other side. So you've got, you know, two different trades matched together, and this is what creates what we call that condor. And it's a really great, I love to use this when you're using a like a debit spread, call debit spread or something, or a put debit spread, and you get into that trade and then it stalls out. And by, you know, doing this hedge, then it allows you to kind of stay with the trade, and, you know, you're taking advantage of the time or theta decay on your short trade setup that you put against it. So here's an example on, this was on Western Digital that we did about a week back. And so this was on the 14th, and right here it had a really explosive move up. You can see that bar right there. And so this is what we call a volatility squeeze breakout. You can see over here on this right chart these dots here. So we get a period of consolidation where the price is just kind of coiling here, and then we, you know, had a reversal signal, and it really broke hard to the upside. So on this 14th, we went long, set up just a call debit spread right here. Now the next day, I mean, it popped straight up there, looked fantastic, and then all of a sudden it stalled, came back down. So in this market, just wanted to kind of take off some of the risk to, you know, to this downside. So on this day, just one day later, sold the bear call credit spread against it, creating this condor structure. So when the trade was set up on the 14th, it was trading around 90, and then the next day, you know, it came down, it was trading about 90.60. So set up a condor spread on that. So let me walk you through that, show you what it looks like. So here's day one, the 14th, just did a regular call debit spread. So going into the trade, bought that for $1.04, $104 per spread. So this was the 90.5, 93 call debit spread, 90.5, 93. Okay, nice defined risk trade. All right, but then the next day the market started to kind of stall out. So we sold a bear call credit spread against it. And that was right here. Sold the bear call credit spread right there, the 94, 96. So basically we skipped a strike from that 93 that was the call debit spread short, and we skipped the strike out to the 94. So sold a 94, 96 bear call credit spread, brought in $29 credit. So that reduced or adjusted this trade down by the credit received, and now the risk of this whole trade structure was only $75. So we had a risk here of 75 to the downside, and now we only had a risk to the upside of about 75 as well. So we have our long call debit spread here, bear call credit spread here, and this was performing great. Today it's still performing great. So yesterday, or not yesterday, on Wednesday, the market value, it was trading at 92.91, and the spread value then was $128, or 170% return on the capital risk of 75. So we had, you can see here down below, here's the profit per one spread was about 128. So the $104 debit spread was trading at 203, And the credit spread, though, had collapsed, and it went from 29 cents to 2 cents. Now today, this is 0. Basically, the credit spread is worthless, so we get the profit from that as long as it closes below the short strike. And if we get, today, if we have Western Digital close above that 93, we'll get max profit there. So if that happens, this spread yesterday was up 128. If we get that max profit where we get the debit spread closing for max profit and the credit spread could close for max profit, theoretically this trade can bring in $175 profit per spread on your risk of 75. So it's one of my favorite setups because you can start off with a directional trade that you like, either up or down, and if it starts to fail against you, you can quickly neutralize the trade and defend it. So it's kind of like a butterfly defense that I like, but this one gives you a bigger profit window, between your short strikes. So theoretically, this could make 175 then, which would be 233% return. But again, very low capital at risk, and then it gives you a lot of different options and ways to trade in and out of that. And that's the thing I love about it. When you think about options, it gives you so many different options, and it's like I refer to it, they're like puzzles. Once you understand the structures and the fundamentals of the different spreads, you can match this with that and really create some really great adjustment type of scenarios. So here's another one of my really favorite, and this is what we call the ninja credit spread. So what it is basically you're going to see it's basically starting out with a kind of a balanced butterfly, and then you add an additional credit spread to it to reshape the risk up or down. And it's also what's referred to as a ratio butterfly. So here's kind of the profile or risk structure of this. And so, what you're going to see is it basically starts out as what we call the balanced butterfly, and then by adding an additional credit spread, then you shape the risk to either an upside directional bias or downside by doing another credit spread attached to this butterfly. So it's a variation of an equal strike butterfly, but it adds an additional short vertical credit spread. So it's simply two in the money credit spreads then protected by a slightly narrower, closer to the money debit spread. So it creates a very low defined risk directional option strategy, and then by either using calls or puts, you can alter the risk to one direction, and that's also going to then increase the potential of your reward in that direction that you're structuring the trade for. So here's a really cool example of a trade setup that we did, unbalanced or ratio butterfly on Apple. So it'll show you just how tremendous the potential returns can be on very defined risk types of trades. So this trade is also, everything I look at is also based on direction, but then we look at what's the best, option strategy for the current market condition that we're trading. So first off, this was a directional trade. We looked at Apple, and we had a reversal signal here, and it pulled back pretty hard. But what we were looking at this was a monthly option expiration, and we were seeing huge amount of unusual, we could call it unusual option activity at the 160 monthly strike. Okay, so also like to incorporate Fibonacci. So we had a pullback here, and it held that 618 right there, and then we saw big option activity at the 160. So we were looking for a push right back to the 150 or the 50% Fibonacci level here at 160. So it gave us a great target to trade to. So I always want to look at where's my target, my price target that I want to trade to. Now, when you start using these types of strategies, you'll see they're very short duration. You can do, this was put on the 13th, and it was traded into expiration on the 15th. So you can do these strategies and make big money on very short duration trades and also very short small movements. So this one was actually set up when Apple's trading at 159. We're just looking for a move up to 160. So to do this, we did this using what we call this put ratio, or this was actually a call ratio butterfly. So when we break this down, you're going to see that you basically have two different trades set up, and then you put it together, and this creates the ratio butterfly. So Apple was trading at 159. We had the target just to 160, $1 up in 2 days expiration. So part of this trade then was buying the 157.5, selling the 160, That's a call debit spread. And then this is where you bring in the additional credit spread. Then we sold two 160, bought the 160 bear call credit spread. So we have two bear call credit spreads and one, basically long call debit spread. So when you put those together, that's what's creating this bear call ratio butterfly. So it basically starts out with a balanced butterfly. You add additional credit spread to it, and then you've got this what we call the unbalanced ratio butterfly. So let's go through the structure, and you'll see how it works. So when this trade was set up on the 13th, Apple was trading right about 150, right about that area. We're looking for a target up to 160 into expiration. So this was actually set up just costing $15. That's the maximum cost of this trade, $15, 15 cents, $15. Now, your risk then to the upside, so the way this was structured, the risk to the upside would be greater because we were looking for it to go out at 160 based on all this huge option activity plus that Fibonacci level. So the cost of the trade was 15. Now, the upside potential risk was 265, but the max profit theoretically was 235. So it had a great structure to it, and I'll walk you through it to show you. Now, so the cost was 15. So that would be the risk to the downside. The upside risk is 265. Theoretically, you could make $235 profit. So if you look at the return, it's huge. So the return on this, if you look at the downside risk, 15, that'd be over 1,566% return on your capital on the downside risk. The upside risk, that would be a return of 89, still not bad. Now the great advantage is positive time decay plus, this is the other huge part, volatility collapse, okay, and high return on capital. So this was actually taken off on the 15th at expiration, and the spread made $212 per spread. So you'll see if you look at that, that's a 1,400% return on your downside risk of 15 and 80% risk on the maximum overall risk. So let's take a look at the option profile. So the first thing would be, this starts off, if you look at it together, it's a balanced butterfly. So here's the butterfly component, and that's the 157.5, 160, 162, balanced $2.50 wide butterfly. So if it goes out right here at the top of the 10th, that would be max profit. Now we nailed it on this trade based on that option activity, and it was going out almost right at 160, almost, well, it was back and forth, pretty much close to 160. So you can see just from the balanced butterfly, that part of the trade cost $70, and on the 15th, that part of the trade was almost max profit, 175. Okay, so that's just on, that's part of the component of the trade. So that's the balanced butterfly. But we added a bear call credit spread additional to it right here. Okay, here's your bear call credit spread. Brought in $55 credit, and it was going to close right there. So that was going to be max profit of 53. So you combine those two together, and here's the structure of an unbalanced or ratio butterfly, call butterfly. So we've got now this structure where we've got our maximum risk to the downside is $15. Okay, so that's the most. If this thing collapsed, and then your upside risk is greater. But the key takeaway here was there was huge open interest and option activity at this 160 strike, so that's why we structured it this way. So you can see the butterfly part would have made 75 or made 175. The credit spread made 53. So the total together on this spread is $228. Okay, versus if you just did a butterfly, if you just did a bear call credit spread. So huge return and a great structure. So the actual trade setup then for us was it made 227 was where it was going out, less your $15 cost. So the trade setup was $212 per spread. So to your downside risk of 15, that's 1,400% return. Return on your downside risk, was 1,400, and the return overall was 80%. So you can see here just on 4 contracts and your risk, these things can really make a big payoff. So this was went out at 227 less the cost, and you can see where that return was. So it's a really great strategy for that type of market environment where you have a good idea of potentially where that strike's going to settle out based on looking at open interest, option activity, Fibonacci levels, however you want to analyze your market. But another great opportunity there, using the right setup. So I could spend hours on this subject, but if you'd like to learn a lot more, I've got a really great package for everybody here today. It's kind of an extra special package, and I'll show you why. So if you'd like to take advantage of it, here's the link, and it's powercycletrading.com/LIKE. Okay, so use that link there, and what you're going to get is you're going to get this course that I did about a month back. It's selling options for income, profits, and opportunistic hedging. It's recorded on demand. It's a 5+ hour course. You'll get the full course broken down in modules, so you can go at it at any time. Be on your cloud, so you can access it and go through it with these modules, so you can follow it along easy. Plus, you'll get the full detailed PowerPoint. It's over, I think, about 200 or 300 page PowerPoint course. My courses are very detailed. So I've got another additional great bonuses here for you. So what I'm going to do here today for everybody here is I'm going to throw in at no additional cost, as part of the bonus of the course, my cycle reversal indicator that I showed you. So this is a software indicator, and we've got this for Thinkorswim and TradeStation. So if you buy here today, everything in this package, it's $97. So you're going to get the recorded on-demand course. If you go to the website, it's $297. You're going to get the cycle reversal indicator. It's on my website, $197. Plus, we're going to do a follow-up Q&A live, which will also be recorded. We'll do this in about 2 weeks. Give yourself time to go through the course. You're going to get my options strategy manifesto, which I'll show you in a minute, my Greek power tool guide, and for anybody that's never been a member to my trading club, you'll get 1 free trial month there, and then if you'd like to continue, it's $97. So this is today, not tonight. So if you'd like to take advantage of this, let me show you where you can go. Again, use this link and put that in, powercycletrading.com/like. So the bonus indicator here is the cycle reversal indicator that we designed. Set this up, for spreads, but it's great for these types of alerts to a change in direction. So it's based on relative strength, and it measures. It's got 2 parts of the indicator. You've got the upper study and the understudy, lower study. So it measures overbought, oversold, and then it gives you a signal. And these are advanced signals, basically. You're going to see if you're using it for a daily time frame, this will give you an advanced warning for a reversal 1 to 2 days. Or you can use it for, lower time frames as well, 60-minute, 4 hours, whatever. But I love to use it for the daily, and then intraday I'll use it on like an hourly or 30-minute time frame. So then you get the upper study, which also then gives you arrows. So it's going to give you, when you get a cycle reversal, you'll get a down arrow. I've got it magenta. When you get a cycle reversal to the upside, it'll give you a green arrow or blue arrow. You can change the colors in the studies, which I teach you in the course how to do all that. So it's something that we use for, all kinds of reversals, either up or down. And we use this for swing trades, day trades, long-term trades, and also for spread trades. So it's really good if you do spreads, and it'll help you on your really timing your entries better on a spread trade as well. So you can see here's what it looks like. Here's your cycle reversal indicator there. Here's another one. Here's a cycle low. So just a really cool indicator. So that'll be part of your package here today, and throw that in for additional bonus for everybody, and that's, you can have it for Thinkorswim, TradeStation, or both. Now, in the course, what we go through are the option Greeks, and how vital those are for the credit spreads, how, why, and when to use credit spreads, how to use the cycle reversal indicator for these credit spreads. So we go through in detail in the course on how to do that, how to set it up, and then incorporate this for your spread setups as well. Go into great detail on how, why, and when to use the Ninja butterfly, the advantages of this ratio butterfly, and then I love to use the credit spreads for the index options. So show you how to do index option spreads for SPX, RUT, NDX using credit spreads. And then a lot of questions, when do you put these on? So I teach you, you do it 5 days out, 10 days. I've got a kind of a formula for that and a specific kind of setup that I look for. And then how, why, and when to use credit spreads and the butterfly spread for, what I refer to as this opportunistic hedging. So, you can then have whatever trade core position you might have, and it starts to go against you. I want you to learn and understand how to hedge it. And so that's what I teach in this course, using butterflies and condors for your hedging. And then also for the credit spreads, I teach you 6 defenses for making adjustments to a credit spread that you have that might be going against you. And then a big one again is, using that condor defense, position sizing using credit spreads, how that can help you reduce your risk, and step-by-step guide for putting these on. And you'll get a great library of credit spreads that you can go through and look at past examples. So one of my clients said, Larry, I've been using that Ninja Fly, and it's the most incredible way to put really great option positions on. I've made huge gains on SPX trades, and thanks for teaching me this strategy. I can't wait for the next course. So nice feedback there. I'm about running out of time, but let me review this one more time for you. So you're going to get my step-by-step selling options for income, profits, and hedging. 5-hour recorded on-demand course broken down in modules. It comes with a 389-page training manual, so very detailed. Then you get a follow-up Q&A, which will also be recorded. You'll get my strategy manifesto. So this is 15 option strategies, some of my favorites. So it shows you can print it out, put it on your desktop. It gives you the profile, what those are, defines the risk-reward parameters. And then my Greek power tool guides, you can also print this out, put on your desktop, tell you what all the Greeks are, so you have that right at your fingertips. And then you'll get my free trial to our trading club for a month, and we've got a virtual trading room open each and every day. You'll get access to my daily videos telling you what the markets are doing from my perspective, what trade setups we're looking at. We do a weekly Q&A, so that's live, also recorded. Traders Educational Vault. You get a credit for every $20 credit for every month you're a buyer, and 50% discounts and more at times for courses and software. So great package. Hopefully a lot of you will take advantage of it today, and I look forward to working with everybody here hopefully in the future. So thank you very much. And I think I'm out of time, but I'd be happy to take questions if I'm not. So there you go. No, if you've already done a trial, we only do it for anybody new that's never had a trial before. So if you'd like to stay with us after your trial, then it's $97 a month, or you can do an annual membership that's much less than that. Hey, TJ. Question, do you put the Ninja on at once and take it all off at once? No, that's the great thing. You can take it all off at once, or you can, leg out of it, because when you break down these spreads, they're just a combination. So you're going to see it's a combination of a bull put credit spread, or or a debit spread. So that's the great thing. You can get out all at once, or you can leg out, from the different spreads. So that's the thing I like about options. There's not one set way that you have to do it. Question, how do you identify standard deviation? The course, I go through great detail on standard deviation and using those statistics. So for $97, you're going to learn all about standard deviation and statistics and probabilities. So in an easy to follow course. So definitely would recommend it if you're questioning standard deviation, how to use that. Very important that you understand statistics. Now, trading, really, if you look at it, is a business of probabilities. So definitely take advantage of this offer and learn about, using probabilities in your trading. So I'm big into statistics and probabilities, so it'll be a good one for you. Yeah, you can do all these strategies on TradeStation. Yeah, and the reversal indicator, you can have it for TradeStation or Thinkorswim or both. Yeah, so use this link here, and then once you buy the course, just send us an email and let us know what platform you need your indicators for. And we'll send you the instructions for uploading that, and then the course will teach you how to use that indicator. Now the great thing too is the indicator, you can use it for any of your trading. It doesn't have to be just these kind of option trades that I'm talking about today in this presentation. Yeah, so always look at earnings. That's a big part of trading in general. So I never want to have a specific trade on into an earnings release, which I referred to in the course as well. The Option Masters Workshop is more focused on just the overall market, Greeks and stuff, versus this course goes through the Greeks, but we really focus in on the selling option strategies. Okay, so selling credit spreads, ninja credit spreads, butterflies, condors, things like that. Yeah, of course you can use this for trading forex. It works on anything. Forex, foreign exchange. I used to trade a lot of foreign exchange, so it works great on foreign exchange, ETFs, futures, whatever you like to trade. These trades, I like short duration trades, so we call these kind of swing trades. These will last. You could be in one of these trades for 1 day, or you could be in for 2 weeks. Usually I try to structure my trades for 4 to 5, 7 days out. So when you look at trading, in options especially, time equals risk. So, the less time you're in a trade, the less things can go against you. So I like kind of shorter duration trades. So, look at things, 1 day to 7 days out, something like that. And that's what's great about weekly options. So a lot of this course will be, showing you these various trade setups using weekly options. Yeah, the trading club is, we have a virtual trading room. So it's basically, I like to look at myself more as a teacher, trying to teach you the things that I've learned over the years, the different trading strategies and things. So when you come in the trading room, you can ask for, if you're looking at a certain setup, and we'll show you the setups that I'm looking at and how those work and how to structure those and put those on. So that's what we kind of have the trading room set up for. So you can come in, ask questions, and I can show you the setups we're currently looking at for the various market conditions that we're in. So, for last week, we set up that condor, and here's just another one. This week, we set up actually a butterfly for Alibaba. We were looking for a move to back to 190, that prior high, and I was thinking that, based on this week being a short week, that Alibaba would probably push up here to 190 and stall out, which actually it did. So with that condition, we set up a butterfly, and so here's the butterfly we set up, and it looks like it's going to really be a super good payoff. So we set up a butterfly. We just did the 187.5, 190, 192 balanced butterfly. And, it's set it up at 50 cents, and it's going out right here, making about $60 per spread. So really low risk trade setup, but that's, the kind of things I like to look at, the current market environment, and then structure trades accordingly. So that was another example that I didn't really get to cover here today, but that was just a balanced butterfly. Yeah, so if you have a full-time job, these are great types of trade setups for you, because you can put on these types of strategies, and you know what your defined risk is going in, know what your potential profit is, and you just check in, during the day if you can. You don't have to be glued to your screen all day long. And the other thing, when you look at butterflies, they're also a lot of times what we refer to as vacation trades, because you can put on a butterfly spread for very little at risk, and you can just go away and leave it alone and come back, closer to expiration, and then go from there. So it's great for people that can't be trading full time. I use Thinkorswim and TradeStation platform. Yeah, so here's the link again, powercycletrading.com / just type in LIKE. So you should be able to just click on that link, or if you can't, just type it into your browser or copy it and paste it. And then we'll get you out that indicator as soon as we can. Since today's a short day, probably won't get the indicator until probably Monday, and you'll get all the course and all that stuff as well as ASAP.
Thank you, Larry. Appreciate it, man.
Thanks, Hubert. Have a great rest of your day, and everybody else, enjoy the rest of your day and your weekend. Thank you.